Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I'm going to take a break on the trading psychology problems, and that's something that I really want to come back to, but I figured this week, because the market had gotten a little iffy as of late, it'd be a good time to revisit market timing and the importance of market timing. I do have a mystery chart I want to show you real quick before we hop into everything. I'm going to revisit the TFM 10% system. And that's something that we covered in a prior show, and you'll get a link to that. I'll show you in just one second how to get a link to that prior show for a lot more details. There's certain aspects I want to cover on it in this show. And if we have time, I want to get into additional ways to help stay on the right side of the market. Housekeeping, I do take requests. As I've been saying ad nauseum lately, though, I've been so backed up, and there's so much I want to cover here in Trading Simplified. I just hadn't had time to cover anything in addition, but what I'll do is, if you do email me something, I will cover it in my Weekend Charts show, which is Thursday nights right now. And you can find out more information at DaveLandry.com. If you need to reach me, DaveLandry.com/contact. If you want the slides to this show, a link to a page with all the shows and all three of my books, and a plethora of other information to keep you busy, including a mini market timing course, which we're going to talk a little bit about today. Then go to DaveLandry.com/StockCharts. Easy for me to say. All right, let's take a look at this mystery chart real quick. And we don't have a lot of methodology or any methodology in action this week. I'll save that for upcoming weeks. It just really hasn't been a whole lot of setups as of late, and that's based on the conditions with the overall market. And I often say I let the database tell me what to do, and people say, well, what do you mean by that? It's like, well, I look at a couple thousand stocks every night, and if I have hundreds of shorts setting up, then I know I need to be shorting the market. And we did put on a couple of shorts recently, and we'll cover those in upcoming shows. And if I have hundreds of longs setting up, then I look to get long. And if there's just a few of each, and I really can't find much to get excited about, then I mostly sit on my hands. And that's why in my trading service for the past couple of weeks, I haven't told my peeps to do a whole lot. Now, this is a fairly new issue. I would consider this still an IPO. Notice that it came public and failed miserably. What I recommend, because many IPOs come public and immediately fail, is to wait at least 5 days. So the earliest I will actually get into an IPO is the close of the 5th day. Now, we've talked about some IPO patterns in prior shows, so check those out for how I approach IPOs. But I can assure you, if an IPO is going straight down, I will not buy it on the close of the 5th day. Now, if it closes up here somewhere and I'll do closing high, then I'll consider it as a possible setup. If you want to see where I came up with this particular stock and nearly all the other stocks that I mentioned as mystery charts, go to DaveLandry.com/archives, and I'll update those archives soon after this show to make sure you have the current ones. You can see it bottomed out very nicely, made a nice little cup and handle type of pattern. I literally got in about an hour ago on this one as it broke nicely above the previous day's high. My stop is down here, just in case I'm wrong. I hope I'm not. And initial profit target is up there. And we'll follow up on this one in upcoming shows. Again, DaveLandry.com/archives to see this mystery chart once it's revealed, and pretty much all the other ones that we talked about. All right, this is what I want to jump into, timing the market. And there's a lot of things to think about when it comes to timing the market, and that's why I have a question mark on there. And we'll get to that. As I said in the previous show, market timing is less about beating the market and more about not letting the market beat you. Avoiding the occasional 50% haircut is key. And the old hedge fund adage, he who fights and runs away lives to fight another day. Bad things happen below the 200-day moving average. That's Charlie Baleo and Michael Gayard. They wrote a paper, and they won some awards based on that, and that makes a lot of sense. Well, before I knew about that, I had come up with this little, what I call the buy line, which is part of ACP. And after reading the quote from those gentlemen, I thought, well, bad things happen below the 10% line. So the 10% line, what I often call, again, as the buy line, is the 50-week closing high less 10%. Now, in ACP, the parameters are fixed at 10%, and I will talk to the programmers for our next release to see if we can get that to open up. And the reason I'm saying that is 10% is a good number for the S&P 500, and maybe something like 15% would be a good number for something like the NASDAQ that's a little bit more volatile, or other volatile markets we may be using. So as a general statement, you want to be long above the 10% line and out of the markets or short when you're below that 10% line. You can see some really bad things can happen when the market drops below that 10%. Now, sometimes it comes right back, and that can be called a whipsaw, although this last little drop was very impressive once we got below that 10% line. And I think buying and holding through that, or holding through that, I should say, is a really bad idea. And I'll flesh that out in a little more detail in just one second. So if we take the histogram of the percent drops and we flip it on its head, and this is an indicator that is available in StockCharts, by the way, it looks something like this. You can see that once you start getting well below 10%, things can get pretty ugly. Obviously, the Great Depression all the way to the left. And in 2009, the market lost half of its value. And also, the NASDAQ, of course, lost half its value in 2000. Then it lost half of its value again. I think overall it was a 77% drop in 2000. And this last little slide was nothing to sneeze at, although it came right back. And I'm going to cover that in just one second. So let's talk about the rules real quick for the TFM 10% system. And keep in mind that I went into a lot more detail in a prior presentation on this, which if you put in your information to davelandry.com/stockcharts, you'll get a link to that page where all the presentations are. So check the one out on market timing. Also, if you want to get into a lot more details, you'll get the mini market timing course to go through that. But basically, my point is that as long as a market is near C, and this all boils down to the concept of the ABCs of technical analysis. If the markets go from A to C, and B is somewhere in between, then it's going to have to pass through B along the way. And I actually have an IPO pattern that pretty much does just that, buys at B, so to speak. And that's the name of it. So near C means that as long as the market is near that C, the new highs, then you want to stay long. So I define near C as within 10% of its 50-week closing high. And then as a whipsaw filter, I have in there, you have to have 2 weeks lows, which are greater than the 50-week moving average. Now, this is the weekly market timing system. So in other words, 2 weeks or 2 bars on the weekly chart of Landry light. Now, the exits are a little bit less stringent because you want to sell first and ask questions later. So you want to exit when the market is 10% or more away from its 50-week closing high. In other words, no longer near C. And the close is less than the 50-week moving average. So we don't require any downside Landry light. Because if you wait for that to happen, it might be too late. Now, one thing about market timing that's kind of interesting is it just doesn't work very well when the market has a do-over. And I think a lot of careers have been saved when the market has a do-over. So let me explain that first before we get into any details. As you can see, we have a sell signal here. And again, this is all in the ACP plugin, which if you're looking at live ACP, like this video, if you like this video, the little plugin will appear down here and you can get the plugin for free. So all you have to do is like the video. And you can see that we have a close. So we have a close below the buy line, which means it's 10% or more away from the 50-week closing high, which was just 2 weeks prior in this particular example. And then in this particular case, you can see the market made this V-shaped recovery. It just came right back. So that buy line never had time to catch up with the overall market. So you're pretty much selling and then you're actually buying in the market a little bit higher than where you got out. And that can be a little frustrating. But again, he who fights and runs away lives to fight another day. So again, you can see we actually bought higher than where we sold the market. Now, where it begins to pay off is in a case like 2000, 2008, where the market drops below that closing high and then begins to trend lower. So as you can see, back in 2007, the market dropped going into the end of the year it dropped a little, almost 10%, and then early into 2008, it was more than a 10% drop, and you were below the 50-week moving average. So if you look down at the ACP plugin below the indicator, this just illustrates how many percent you are, or it actually tells you how many percent you are away from the 50-week closing high. In this particular case, just above 10% away. And then the other thing is it closed below the 50-week simple moving average. So that was a sell signal right there. And what's cool about this sell signal and sell signals and other things that I follow, such as my bow ties, and I'd be willing to bet Landry light too now. We'll take a look at that if we have time towards the end of the presentation. But the cool thing about this particular signal and some other signals that I followed, because the market had kind of a gradual rollover, these signals began to trigger fairly early. And it's like people always talk about how bad things were in 2008. It's like, well, I don't remember them being that bad because we were mostly short, because we had short setting up going all the way back to October. And you could see that the market was kind of gradually rolling over. Now, as I said earlier, and Mr. Billio and Gayard said, bad things happen below the 200-day moving average. Well, bad things happen once you get past the 10% line. And in this particular case, the market obviously lost over 50% of its value. Now, notice that because the market sold off for so long, that 50-week closing high began to drop, and the 10% below that line began to drop with it. And that had you getting back in the market at much lower levels, as opposed to recently when it had you getting back in above where you actually sold. So this is kind of a neat thing to happen here. By the way, when we look at the actual spreadsheet, what we're measuring is how much drop would have been avoided by getting out of the market. So from here to here by being out of the market. And as far as I'm concerned, that's the most important thing when it comes to market timing. So you can see we're above the buy line, and then we had 2 weeks of Landry light above the 50 simple moving average, which is a 50-week moving average because we're using a weekly chart in this case. And if you look down at the percent from closing high, you can see that we dropped below 10%, suggesting that the market is improving, obviously. So I had originally did the research going back about 30-something years, and I remember when I did it, I was a little bummed out because it really didn't beat buy and hold at all. And then the market began to tank a little bit, and all of a sudden it started to win. And when I updated my numbers on Monday, I was a little disappointed because buy and hold actually is winning once again, going back 30 years. But again, the real thing that's important is avoiding these diaper change moments. And you can see 40-something percent or 50-something percent in this particular case is after you get out of the market. So this is what you avoided. By the way, diaper change comes from Ian McActivey. He's no longer with us, but he was absolutely awesome. I wish he was still around, just so I could pick his brain on precious metals and things like that. He was a specialist in that, and he knew a lot about economics and all. A great guy, and just fun to be around. But anyway, you can see some pretty serious slides, and even that last little slide, we had a pretty serious slide back in 2019, I should say. And that was nothing to sneeze at. The low of that move was pretty big. So you spent about 7 years out of the market, out of those 30 years, or 21% out of the market. And what's kind of cool here, though, is even though it didn't beat buy and hold, you made 97% of what you would have made by buying and holding, and you would have avoided some really serious slides. Now, when we look at this graphically, it makes a little more sense. Notice your equity curve of the TFM 10% system is fairly smooth and works its way higher, whereas the equity curve, when you put in the diaper change moments, is much uglier. So notice that you'll lose occasionally over 50% of your money with the buy and hold. And looking back to the last time that happened, it took 7 years to recover. And 7 years is a long, 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 long time. If you've got a kid ready for college, and you might not be able to wait 7 years for the market to come back. And here's the deal. It might take 25 years or longer for the market to come back. And everyone has been so sold on the fact that the market always comes back. Well, they don't tell you the fact that it might be 25 years. Now, here's some gleamings. Buy and hold's tough to beat, okay? And that's why, I don't know what the percentage is, but it's high. It's probably in the 90s. 90% of all money managers don't beat the S&P 500. And here's the deal. Everyone looks like a genius when it comes right back. I don't want to throw anybody under the bus, but I really got aggravated. I'm hollering back at the TV the other day. There was a guy on TV, and they were interviewing him, and he was like, see, I told you to hold on. I told you to hold on. Well, the market lost 30% of its value. And yeah, it came right back, but as I often joke, that'll work until it don't. And you got to realize there's a lot of psychology behind losing that much money, especially if you need the money, okay? And it's really hard to lose 30% of your money and keep holding on when you need money. And as I've often said, and I think Greg Morris has used a very similar argument, let's say you saved up $1 million for retirement and then the market tanks and drops 50%. Well, your retirement with $1 million is going to be a lot different than your retirement with $500,000. And it could be, and counting, or going down, I should say. So everybody looks like a genius when it comes right back. And I would challenge these guys that buy and hold is a bad thing. And I got to thinking about it. It's like, well, how can these guys survive? Well, these guys could survive. Let's say they have a 25-year career and they're lucky enough for the market to come back on every spill during that 25 years and they're a pretty good run. Then they look pretty smart. Then they can retire. When is the key word in that sentence. Everybody looks at a genius when it comes right back. We could have easily continued lower, obviously, earlier this year. Now, one thing that I was thinking about is in defending this little simple system here is it should improve when previous bear markets and future bear markets are added in. And spoiler alert, I'm going to show you a little bit of that in just one second. Buy and hold is great as long as you don't need the money. And I hear that argument a lot. Well, you better not need that money for at least 25 years, and it could be even longer. It, pronounced with a silent SH, happens. Things happen really fast. Things go south really, really fast. So 25 years might not even be enough time, and people have laughed at me when I said that before, but if you look at the charts, there's been periods where it's taken that long for the market to come back, believe it or not. So don't believe me, you can look at the charts. Also, if you put your information in davelandry.com/StockCharts, I'll get you a copy of the Layman's Guide to Trading Stocks, and I've got some of those charts in there. So even though I didn't kind of knock your socks off with this little system for the last 30 years, although market timing is tough, I think you must do it. Now, Greg Morris had an interesting quote in his book, Investing with the Trend. Buy and hold metrics are based on an 81-year time horizon. I did a course called Trading Full Circle where I said 81 years, and I quoted Sweet Brown. I said, ain't nobody got time for that. And his argument is that you're a young person, you don't get around to save much money because you don't have a lot of money, and then you get married, and then you really don't have a lot of money. Then you have kids, and then you really don't have a lot of money, and then you get a mortgage, and you get car payments and insurance payments and health insurance payments and a plethora of other things, and you really don't have much money to save and invest until you get a little bit older. So 81 years is probably not feasible for most people. The secret is to market timing is avoiding diaper change moments. And it's not a grail that I'm showing you here, but I think it's better than nothing. It's an okay tool, but I would use this and others, and I'll show you a few of those others in just one second. So I woke up this morning thinking, why not just grind it out and take a look at what would have happened if you go way back in time. By the way, when I do any system testing, I like to do it by hand. Years ago, I used to program a lot of systems, and I did some consulting, and some of that consulting involved me doing some programming and analysis of systems, and it just I was on a holy grail hunt where I woke up and programmed several hours every morning working on systems, and sometimes throughout the day and at night. But now I like to do things by hand, so I get a feel for how it actually works. So if we increase that look back to, let's say, close to 100 years, how important is it to avoid diaper changes? Well, it turns out that's pretty darn important. So going back 90-something years, here are the worst diaper change moments. And these are losses that you would have avoided by exiting the market. So you exit the market, then it drops another 85%. So that's pretty ugly. How's that for an oxymoron from a trend following moron? Now, I did go back 90-something years, and the bottom line is avoiding those diaper change moments makes a huge difference longer term. So although based on this last little V-shaped recovery, the TFM 10% system doesn't look that impressive. If you go back 90-something years, if you'd have put 10 grand in the market back to 1928, that's the earliest data point I had in this particular case, you'd have made $1.8 million on that $10,000, or an 18,815% return. Not too bad. Over 93 years, round numbers. Well, where the TFM system began to kick in was by avoiding those diaper change moments, you had actually made $6.3 million, or 63,246%. What's interesting is 30 out of those 90-something years, or roughly 32%, or a third of the time, you would be out of the market. So there's a lot of nights where you would be sleeping. The worst thing you would have would be the FOMO. And the system eventually gets long again, so you would know that it would eventually get you back into the market. Now, when I plotted the new plot going way back in time, $6 million versus less than $2 million, you could see that avoiding the diaper changes makes a huge difference in the performance versus buy and hope. So although we're looking at long-term metrics here, we could have another bear market in the not too distant future. And I'd be willing to bet, if you even looking at those shorter term numbers back past the last couple of bear markets up until now, like I did with the previous slide with the previous spreadsheet, I'd be willing to bet that the buy and hope would underperform based on the fact that it has to recover. By the way, remember that if you lose 50% of your money, you have to make back 100% just to get to break even. So by keeping the drawdowns relatively small, somewhere not too far past that 10% number in the TFM 10% system, you will avoid that recovery. And if you only lose 10% of your money, I mean, it's still going to hurt, but you only have to make back, if my math is correct in my head, about 11%, 11.1%, I think is the actual number, to get back to break even. That is a little bit more doable. So let's touch upon a couple of ways to stay on the right side of the market. Now, keep in mind, even though the system, the TFM 10% system, might take a while to get you back in the market on a V-shaped recovery, there are other shorter-term signals you could use. For instance, with the ACP plugin, my plugin, you could see that we had Landry proper order, meaning that the 10 was greater than the 20 and the 20 was greater than 30 moving averages. 10 simple, 20 exponential, 30 exponential, the bow tie moving averages. You could actually just click on that and it'll load for you. For a long time, going way back to May. So that suggests the trend was turning back then. We started seeing long side setups. Now, by the way, you will be a little late to the party with trend following, and then eventually I'm going to do a segment just on the pitfalls of trend following, even though I think it's the greatest thing since sliced bread. there's a lot of pitfalls to trend following. But anyway, getting back to the bow tie proper order, when the moving averages begin crossing back and forth, and they're not an uptrend, proper order, downtrend, proper order, the indicator turns yellow at the bottom, or as I often say, the illustrator. And then when the moving averages turn to downtrend proper order, meaning 10 below the 20 below the 30, it turns red, and then it turns back green when they cross back above. Now, Landry light is one of the simplest things in the world, and I'm pretty excited about it. It's really cool. You can see Landry light is when the lows are greater than the moving average for the upside, and the highs are less than the moving average for downside. Now, we did have a kiss or two, you can see in this last little trend, but that's okay. That's actually a tradable pattern. Wait for 10 days of Landry light, and then a pull back to the moving average, and then look to get long. In fact, I think if you were newer to trading, or if you're not successful at trading, trade only Landry light or some other simple pattern until you get a feel for it. So the buy would be 10 days of Landry light plus the kiss, and we've talked about this quite a bit. Now, if you look to the right, we had 1 day of Landry light below, 1 day of Landry light above, and so if you look at the little histogram at the bottom, kind of squint your eyes, you can see above and below red and green respectively. We turned red for a while recently, which had me a little concerned about the market, and that's probably what prompted me to dust off all my market timing systems. And then we had 1 day of Landry light, 0 days of Landry light, and if today and future days obviously stay above the 30-day EMA, which I've been using a lot lately, which is lately my favorite moving average, we'll do pretty good. So notice that we've had proper order for quite a while. We've had Landry light for quite a while. And then remember, an indicator doesn't indicate anything. It just illustrates what's already in the chart. Make sure you look at the chart itself, okay? So obviously these moving averages turned down, but the proper order is still an uptrend proper order, even though they've turned down. So you want to pay attention to that and price itself. And you can see that we got below the 30-day EMA, so the proper order up here went to 0 or negative. Each day that it's below, it stays negative. And then you can see it's been negative for a little while after it crossed below. And finally, the moving averages, as you can see, did begin to cross. And when that happens, it goes from green to yellow. And when they cross over to the downside, it turns red. Now, that had me a little bit concerned that we're red. The good news is, as long as the market closes above the EMA, that's going to change really quickly. In fact, we could go back to uptrend proper order soon. Well, that's all I have for today. I want to thank everybody for watching. Any follow-up questions, feel free to leave a comment below. I do answer all comments. If you need to reach me directly, if you have a request, davelandry.com/contact. If you want all information I talked about throughout this presentation, including a mini market timing course, which is relative to what we talked about today, davelandry.com/StockCharts. I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.